Ladies and gentlemen, good afternoon. Welcome to the AMCHAM webinar on 2020 tax law changes and impacting foreign companies and foreign invested Korean companies. My name is Jay Shim. I'm Senior Foreign Attorney at Lee & Co. and Co-Chair of Taxation Committee of AMCHAM. This is the 11th edition of AMCHAM webinar series since AMCHAM launched its new online platform back in April as a response to the new era of social distancing. It has been a great opportunity for the AMCHAM community to engage with experts located in multiple jurisdictions, which is possible only through this format. I'm glad to see that today we once again have a strong turnout with more than 100 guests registered, including not only AMCHAM members, but also the local industry and Korean government personnel as well. Before we begin today's webinar, I will briefly introduce the program and go over a few technical details. Our program will begin with a presentation from our first speaker, Mr. Tae-Gyung Kim, who is a tax partner at Lee & Co. Next, we will have a presentation from our second speaker, Mr. Tae-Gyung Kim, associate of Yoon Yang. Although their names are similar, please do not confuse the two. Next, we will hear, following the two presentations, we will have a Q&A, which I will moderate, following questions we receive from the audience, as well as questions we have prepared in advance. Since some of you may be new to using Zoom, let me give you a quick introduction to the software. First, please note that all of your microphones are automatically turned off. However, after the presentation, you will have an opportunity to ask questions. And you can do that by typing your questions through the Q&A box at the screen below in your computer. We will now begin our webinar with Mr. Tae-Gyung Kim's presentation. Thank you for, again, joining, and hopefully this webinar will be useful to you. Thank you.
Hi everyone, thank you for participating in this AMCHAM taxation webinar. I am Tae-Gyung Kim, a tax partner at Lee & Co. In part one of today's webinar, I am going to explain some recent amendments relating to 1, the beneficial ownership rule and the new offshore investment vehicle regime. 2, the substance of the form rule of transfer pricing and shifting the burden of proof. 3, taxation of royalties for non-registered patents in Korea. 4, transfer pricing on low value adding intragroup services. Lastly, a few other amendments. The beneficial ownership rule as an anti-avoidance rule has been very controversial in Korea for a long time. There were important tax law amendments to this which took effect from January 1st, 2020. The beneficial ownership test and the substance of the form rule have served as a general anti-avoidance rule in Korea in terms of the application of tax treaties. The Supreme Court of Korea has made a series of decisions on the application of tax treaties to capital gains on the transfer of shares, which were not consistent with the OECD position. The Supreme Court made a decision that a Cayman limited partnership is deemed to be a corporation under Korean law. A Cayman limited partnership is the beneficial owner of Korean source income. In the 2012 Lone Star case, the taxpayer claimed the exemption of capital gains tax on the transfer of shares in a Korean company. by applying the Korean-Belgium tax treaty. The Korean tax authorities denied the treaty benefits and assessed personal income tax. The Supreme Court ruled in 2012 that a Cayman limited partnership is considered a beneficial owner as it is deemed to be a corporation for Korean tax purposes. No treaty benefit is allowed as no tax treaty exists between Korea and the Cayman Islands. All capital gains should be subject to Korean tax under Korean domestic tax law. The Korean Supreme Court continued to hold the same position that a partnership or non-taxed entity may be the beneficial owner for the purpose of applying the tax treaty, even though those entities did not have comprehensive tax liability in their residence country. In the 2014 DM Food case, the Supreme Court ruled that a Cayman LP should be considered a beneficial owner, and the US LLC should be considered a beneficial owner to the extent that it's liable to tax in the United States. This decision was the first Supreme Court decision that whether the ultimate investors are liable to tax was considered for the application of the tax treaty based on the Korea-US tax treaty. In the German partnership case, the same principle was applied, even without a specific clause in the tax treaty. The Supreme Court ruled that German partnership should be considered a beneficial owner to the extent that it is liable to tax in Germany. However, investors of other countries were not allowed to enjoy treaty benefits. However, those transactions relating to those court cases took place before the OIB regime was introduced. According to the tax law amendment effective from July 1st, 2012, a special withholding tax rule was introduced in Korean corporate income tax law. It is called the Offshore Investment Vehicle Regime or OIB regime. Under the OIB regime, in order to claim a tax treaty benefit, beneficial owners of income should submit the application, and the intermediary investment vehicles, OIBs, should report certain information about their beneficial owners. The same OIB rule has applied to non-taxation or exemption cases since 2014. According to the criteria for determining beneficial owners under the OIB regime, the beneficial owner must have a comprehensive tax liability under the tax laws of its country of residence. This is consistent with the OECD commentary and the OECD partnership report. Under the OIB regime, a partnership should be treated as a pass-through entity, and the ultimate investors, beneficial owners, should claim the tax treaty benefit. However, this regime was introduced in an application form for claiming treaty benefits under the Treasury regulation, rather than in a tax law or presidential decree. So it was debatable whether the OIB regime was an amendment of the tax law or merely the introduction of a procedural rule. Actually, the NTS argued that the OIB rule is just a procedural rule rather than a substantive legal provision, but tax tribunal ruled in favor of the taxpayer. Under the tax law amendment, the new beneficial ownership rule was codified into the tax law, which is effective from January 1st, 2020. The purpose of this was to bring about some certainty amidst the controversy about whether the existing beneficial owner rule under the OIB regime was merely a procedural rule. In order to make the beneficial ownership rule clear, various related tax law provisions were amended. First of all, the criteria for classification of foreign corporations was amended. According to the amended tax law, foreign partnerships shall not be treated as a corporation. Under the criteria for classification of a foreign corporation, an entity should be considered as a foreign corporation if any one of certain criteria are met. It has a legal personality under the law of country of establishment, or it is composed only of members with limited liability, or it is homogeneous or similar to Korean entity, which is treated as a corporation under Korean law. One of those criteria was that if it had rights or obligations which are independent from those of its members, such as the ability to own assets and to be a party to litigation, it was classified as a foreign corporation. This criterion was the basis for classifying a Cayman Limited Partnership as a corporation under Korean tax law. Under the amendment, this criterion has been deleted. Consequently, a foreign partnership shall no longer be treated as a corporation under Korean tax law. The purpose of the amendment was to ensure a partnership is taxed at the level of its partners. This amendment is applicable to taxable years commencing on or after January 1st, 2020. According to the amendment of individual income tax law, with respect to taxation of a foreign partnership, in the case of a foreign partnership, each partner should be liable to tax to the extent that each partner is identified. In cases where a partner is a corporation, the Corporate Income Tax Act applies to the corporate partner. Under the new OIB regime, a foreign corporation rather than OIB shall be deemed to be the beneficial owner, where it receives Korean source income through an OIB. Where the OIB is a corporate entity, the OIB is deemed to be a beneficial owner if all of the following conditions are met. Number one, the OIB is liable to tax in its country of residence. Number two, the OIB was not established to avoid Korean taxes inappropriately. Where the OIB is a non-corporate entity, partnership, the OIB cannot be a beneficial owner. If the investors are not disclosed, no treaty benefits are available, and the domestic tax rate will apply to the OIB. It looks like this tax law amendment made it clear that a partnership shall never be treated as a beneficial owner, as long as the investor's information is submitted. This amendment was applicable to taxable years starting on or after January 1st, 2020. Next, I will talk about the substance of reform rule of transfer pricing and shifting the burden of proof. According to a recent tax law amendment, the substance of intercompany transactions shall be identified and the commercial rationality shall be considered for transfer pricing. In determining the arm's length price, the tax authorities shall identify the substance of an international transactions clearly by taking into account commercial and financial relations between the associated enterprises, material transaction conditions, and other relevant factors. If an intercompany transaction lacks commercial rationality, and it is very difficult to calculate an arm's length price based on the international transaction, an arm's length price may be determined after denying or recharacterizing the relevant transaction. In terms of commercial rationality, the following should be considered. Number one, whether a transaction could be made between third parties under similar economic circumstances. Number two, whether there is an alternative form for a transaction which is more commercially beneficial. Number three, whether tax benefits have been considered. This amendment was applicable to taxable years beginning on or after January 1st, 2019. Therefore, a couple of years after this, when transactions in fiscal year 2019 will be subject to tax audit, intercompany transactions would be more susceptible to challenges regarding commercial rationality. Under recent tax law amendment, the burden of proof is shifted to the taxpayer for cross-border tax avoidance transactions under the substance of reform principle. In cases where the Korean tax burden is reduced by 50% or more by a diverted transaction, a taxpayer shall prove the absence of the tax avoidance purpose by showing that there were proper business purposes for the transaction. Otherwise, the diverted transactions will be denied, and the tax treaty or the international tax coordination law shall apply as if it was a direct transaction. There is an exception. The burden of proof shall not be shifted to the taxpayer if both of the following conditions are satisfied. Transaction amount for diverted transaction is 1 billion Korean won or less, and reduced the amount of Korean tax burden is 100 million Korean won or less. This amendment was applicable to taxable years commencing on or after January 1st, 2020. I would like to talk about some taxation issues relating to royalties for unregistered patents in Korea. Under Article 6 of Korea-US Tax Treaty, royalties shall be treated as Korean source income only if paid for the use or the right to use relevant property within Korea. The Supreme Court of Korea ruled patent royalties are Korean source income only where a US corporation registers the underlying patents within Korea due to the territorial principle of patents. Patent infringement also cannot occur in Korea where the patent is not registered in Korea. So royalties in respect of unregistered patents of a US corporation shall not be Korean source income. The corporate income tax law was amended to prescribe that the royalties for unregistered patents are Korean source income. But the Supreme Court ruled again whether the royalties are Korean source income shall be decided in accordance with the Korea-US Tax Treaty. Accordingly, royalties paid to US residents for unregistered patents should not be subject to Korean withholding tax. Last year, the Korean government proposed various tax law amendments in order to make it possible to impose taxes on royalty income for unregistered patents, which was effective from January 1st, 2020. Under the amended tax law, royalties for non-registered patents in Korea are prescribed as royalties for other similar property or rights under the US-Korea Tax Treaty. Any income paid for damages of infringement of non-registered patents in Korea in relation to the US-Korea Tax Treaty is categorized as other income. Withholding tax rate for this other income is 15%, 16.5% including local surtax, while other income is generally subject to 22% under the Korean tax law. This is based on the assumption that the manufacturing method, technology, information, and other similar factors of non-registered patents in Korea are used for activities of manufacturing or production in Korea. This amendment was made to secure taxing rights on royalties for non-Korean registered patents. This amendment took effect for relevant royalties paid on or after January 1st, 2020. In relation to taxation issues regarding royalties for unregistered patents, a new principle on the interpretation and application of tax treaties has been enacted. When a term or phrase is not defined in the tax law, sorry. When a term or phrase is not defined in the tax law, the tax treaty should be interpreted and applied as defined or used under the domestic tax law. Transfer pricing rules on low value adding intragroup services have been newly introduced. A low value adding intragroup services means a service provided between a resident and a foreign related party which satisfies all of the following requirements. The service is of a supportive or back office nature, such as accounting, audit, legal, and human resources, management support services, and is not part of the core business. Of the group. The following services are excluded: research and development services, manufacturing and production services, sales and purchases of raw materials, and marketing, finance and insurance and reinsurance. The service does not require the use of unique and valuable intangibles and does not lead to the creation of unique and valuable intangibles. The service does not involve the assumption or control of a substantial or significant risk by the service provider. No similar service transactions are performed between a resident, a foreign related party, and a third party in either direction. The arm's length price of a low value adding intragroup service shall be cost plus 5%. A taxpayer should retain documents proving that the service is a low value adding intragroup service. In addition to the documents required by the current transfer pricing rules, the new rules do not apply where low value adding intragroup service fees exceed a threshold, the lesser of 5% of the sales or 15% of operating expenses. The new regulations are applicable to tax years commencing on or after January 1st, 2020. In the case of the deferment of collection or disposition for arrears for the mutual agreement procedure, the interest rate for deferred payments was 9.125% per annum. Under the amended tax law, for deferment period of 2 years or less, the same interest rate applies. But for deferment periods of more than 2 years, 2.1% per annum interest rate applies. Under the amended tax law, the tax authorities should be able to request information relating to the actual owner from the taxpayer. The name, the date of birth, and the resident registration number, nationality and passport number, or foreign registration number in the case of a foreigner of the actual owner. The actual owner is defined as the ultimate controlling individual. It includes a shareholder with 25% or more, or who holds the largest portion of the shares or investment stakes. Even though it is a different concept from a beneficial owner for the purpose of applying a tax treaty, the tax auditors may request information relating to the actual owner in order to collect the information relating to the beneficial owner. There was also an amendment to the tax law on the income attributable to a Korean permanent establishment. Firstly, the scope of deductible expenses of Korean PE was expanded. Previously, with respect to deductibility of expenses on transactions between a Korean permanent establishment and a foreign headquarters, the deduction was limited to actual expenses incurred under an agreement between the parties within the arm's length range. Under the amended tax law, the expenses which have been incurred in relation to generating Korean source income and which have been allocated in a rational manner shall be deductible, regardless of whether actually paid or not. The MOEF, in explaining this amendment, said that interest expenses should be deductible if incurred in financial transactions to borrow funds for business related to Korean source income attributable to a Korean PE. in order to reflect the OECD model tax convention. However, interest expenses and the guarantee fees paid to the headquarters should continue to be non-deductible expenses. Interest expenses paid to the headquarters would be deductible only when the relevant amendment of a tax treaties takes effect. Secondly, the scope of income attributable to Korean PE was also expanded. Previously, the scope of Korean source income, which is generated outside Korea and attributable to a PE, were listed and limited in the tax law. Under the amended tax law, the list was gone, and all income generated outside Korea but attributable to Korean PE under the income attribution rule shall be deemed Korean source business income. Thank you for listening.
Good afternoon. I'm Tae-Gyung Kim from Yoon Yang's Tax Practice Group. I hope you and your family are all safe and healthy from the coronavirus. I've been eagerly waiting for today's webinar since the original presentation date in March. It is truly my great honor to be a speaker today, and I hope you find the presentation informative. As you may be aware, it's been almost 6 months since the Cabinet Council resolved the enforcement decrees to the 2019 Tax Reform Act in February this year. And it's expected that the 2020 tax reform proposal will be released in August. However, we believe that it's still noteworthy to review what's been recently changed with regard to the tax regulation in Korea. As stated in the message from Taxation Committee co-chairs introducing today's webinar, the tax law reform seems to raise additional taxes or penalties, and also to introduce new measures to prevent tax avoidance transactions identified by the OECD's BEPS project. In this respect, understanding of key tax law changes will be critical for foreign companies as well as foreign invested companies in Korea to be prepared for their business operation. Following Mr. Ted Kim's presentation, I'm planning to present two major areas today. So first, on the 2019 tax law reform, which mostly has become effective as of January 1st, 2020. And second, on the 2020 special tax law reform and measures, which has recently been legislated with the Korean government's strong intention to cope with impacts from the coronavirus or COVID-19. I selected particular topics considering significance of future influence on foreign companies and foreign invested Korean companies. And these are the abbreviations that I used throughout the presentation slides for your reference. So first, 2019 tax law reform. The selected provisions are all from the Adjustment of International Taxes Act, or simply the ATA. The ATA is the Korean International Tax and Transfer Pricing Regulation, which in practice is commonly referred to as the law for coordination of international tax affairs. Topic 1 is notification on submission of duplicate information on international transactions. This revision is to provide exemption requirement for submission of the statement of international transactions and statement of arm's price calculation method. So in practice, when obligated to submit master file and local file, a taxpayer has to also submit very similar or identical information in both of the statement of international transactions and statement of arm's price calculation method for their corporate tax return reporting purpose. For instance, the above left-handed column is the statement of international transactions template, while the above right-handed column is the local file template. As you can see, it's small, but as you can see in the example, both documents require information on accrued amount and paid or received amount for each overseas related party transaction type. Also, as shown in the below example, both statement of arm's length price calculation method and local file require information on applied transfer pricing method and reason for selection of such method. So in these cases, when a taxpayer conducts various overseas related party transactions, their administrative burden increases proportionally, which may also increase a chance to fill out inconsistent information for each document. So after the revision, because taxpayers required to submit master file and local file will not have to submit duplicate or similar information on the two statements for the corporate tax return, tax compliance burden will be reduced at some level. However, it's important to note that timely notification needs to be made to the relevant tax office by the corporate tax return filing due date. Topic 2 is specification of requirements for estimated taxation on transfer prices. This revision introduced new legislation on scope of the requested information for the NTS to apply estimated taxation on taxpayers who fail to submit required information on international transactions, such as master file, local file, and information requested by the NTS. So just for a reference purpose, the left column is the general content of master file and local file, which are commonly known as BEPS reports or combined reports of international transactions. The right column is the general content of information requested by the NTS, which is also known as transfer pricing documentation. This transfer pricing documentation is required by taxpayers that conduct overseas related party transactions, but not applicable to prepare and submit master file and local file. So these are the types of documents that are relevant to this specific revision. So after the revision, because taxpayers required to submit master file and local file or transfer pricing documentation would need to prepare relevant documents in a more effective and strategic way to prevent the NTS estimated taxation. It is highly likely that the NTS would arbitrarily attempt estimated taxation based on its accumulated industry data, while the reasonable estimation is not clearly defined with regard to methodology on how the NTS estimation would be made. Therefore, it's advisable for applicable taxpayers to actively prepare essential and required documents in advance to prevent any potential risk. Topic 3 is regarding standards on additional penalties for failure to submit required documents on international transactions, which I believe is quite straightforward. This revision is for the NTS to impose additional penalties for taxpayers' failure to submit required documents on international transactions. So now a total penalty amount could be accumulated up to a maximum of 300 million Korean won, which is 3 times more than the previous maximum amount. This would reinforce taxpayers' compliance with relevant transfer pricing documentation regulation, and at the same time to increase their compliance burden. This table describes existing or previous penalties for failure to submit required documents on international transactions, which were a maximum of 100 million Korean won, even for late submission after the NTS request. However, based on the revision, the maximum penalty amount would go up to 300 million Korean won. So in addition to the previous revision in my second topic regarding the NTS estimated taxation, taxpayers with obligation to submit master file and local file or transfer pricing documentation would need to prepare the applicable document in a timely manner to avoid any additional penalties for non-compliance and any other potential transfer pricing risk. Topic 4 is obligation to furnish and maintain documents related to transfer pricing method for intangible transactions. This revision is to reinforce documentation on intercompany intangible transactions, in addition to the previous year's revision on the arm's length principle applied to these intangible transactions. Specifically, the previous revisions reflecting new intangible related concepts from the OECD Web Sections 8 through 10 report were on first, so-called DEMPI analysis to determine the actual economic ownership of intangibles. Second, use of valuation techniques such as the DCF method and assumptions thereof to evaluate the arm's length price of intangibles. And third, hard to value intangibles to regulate how often these intangibles have to be evaluated and documented. So after this revision, it's recommended that taxpayers applicable to prepare master file and local file would need to include details of intangible transaction related information, and also that taxpayers not applicable for master file and local file would still need to separately document intangible transaction related information, and it's a separate document. Topic 5 is increased reduction rate on administrative fine for revised and after deadline reporting of financial accounts, foreign financial accounts. This revision would increase reduction rates applied to revised and after deadline reporting of foreign financial accounts, commonly known as the FBAR system in Korea. So the range of reduction rates for each time frame would be now 30 to 90% from the previous range of 10 to 70%. It is believed that there were several reasons which led to this revision. First, the change would reduce penalty burden of those who fail to report without any intention of tax evasion, and also increase inducement of self-reporting foreign financial accounts to report unpaid taxes. And second, the change would provide chances for taxpayers' voluntary reporting for revision or late submission, which would eventually improve effectiveness of the reporting system. Third, there have been active proposals made by foreign chambers of commerce in Korea for increased reduction of penalty for late reporting. This slide is for your information purpose regarding the overview of the Korean FBAR system. As you may see from the penalties on non-reporting, sanctions include administrative fine based on the ATA, as well as another fine or possible imprisonment for an underreported amount above 5 billion Korean won based on the Punishment of Tax Offenses Act. Due to such strict regulation, there has been ongoing debate between taxpayers and the NTS to reduce taxpayers' burden. So as a result, this reform would definitely reduce taxpayers' penalty burden and encourage voluntary reporting of an unreported or underreported amount from foreign financial accounts. Topic 6 is unification of submission method of master file and local file into information and communication networks, which is the same as the submission method of the country-by-country report. This revision is straightforward that the methodology of submitting master file and local file can be only done by electronic filing now, which could be alternatively done by submitting hard copy reports to the tax office. So this electronic system is called the Axis, operated by the NTS. So the left column is displays the interface of the Axis for taxpayers to now submit all the master file, local file, and country-by-country report. And the right column is the NTS guidance on how to submit the report through this Access portal. As this guidance can be found from the NTS website, taxpayers using the Access for the first time may consider reviewing the document. So after the implementation of this revision, the NTS is expected to more easily accumulate and utilize those data from taxpayers before tax audit and for estimated taxation when necessary. Topic 7 is introduction of presenting taxpayers' opinions during MAP process or mutual agreement procedure. Following the revision, the enforcement decree of the ATA, taxpayers may be able to present their opinions to tax authorities during the MAP process before conclusion or termination of the case. The NTS published the MAP guidance for taxpayers in April this year, with the revision to the previous version by reflecting the 2019 Tax Reform Act. Although it's in Korean, after the revision of the guidance, paragraphs 3.2 and 3.4 precisely conform to the ATA and the enforcement decree. As a result, taxpayers' response before conclusion of the agreement can be made or submitted so that taxpayers' opinions can be actively reflected in the MAP process. However, even before this process was explicitly specified, as there has been a continuous exchange of opinions between tax authorities and taxpayers, it's deemed that there will be not much of substantial impact on the MAP progress between taxpayers and tax authorities. Lastly, topic 8 is clarification on return date of transfer pricing adjustment for MAP cases. That return of the relevant transfer pricing adjustment should be made within 90 days from the next day of the MAP conclusion date. This revision clarifies necessary follow-up procedures on TP adjustment for MAP cases. Based on the form, notice of closing a MAP, which is also included in the NTS guidance, the MAP conclusion date refers to the termination date. As such procedure was not clearly defined, this reform has now specified the due date for the return of TP adjustment in MAP application cases. My second topic, for the 2020 Special Tax Law Reform and Measures, the provisions are mostly from the restriction of Special Taxation Act, or simply the RSTA. This RSTA is also referred to as the Special Tax Treatment Control Law, which provides the regulation on tax exemptions and restrictions to achieve specific national economic objectives by imposing taxes fairly and implementing tax policies effectively. The Ministry of Economy and Finance has actively legislated the RSTA to minimize and overcome impacts of the COVID-19. Of the 10 highlights that I've selected, I will briefly touch three provisions, as others are not highly relevant to foreign companies or foreign invested companies. The first provision is relevant to those companies qualified as a small and medium-sized enterprise category. During this year, 2020, SMEs in a so-called special disaster area, such as Daegu, which is the city highly affected by the coronavirus pandemic in the very early stage, are entitled to additional tax reduction with nearly double rates. So based on the Korean government announcement, tax benefits from this additional tax reduction are estimated to be more than 340 billion Korean won. The seventh provision is temporary increase of entertainment expenses amount to be deductible. The government expects that this provision would encourage sales from SMEs and small merchants. The 10th provision is early retroactive refund of operating losses for SMEs during the first half of 2020. So applicable taxpayers would need to carefully review requirements for application, not to assume any penalties from incorrect information in the future. Furthermore, there are special measures provided by the National Tax Service and Korea Customs Service, also with their efforts to support taxpayers challenged by the COVID-19. Both authorities provided supportive means, such as postponement of tax or customs duty payment, and also postponement of tax or customs audit to ease taxpayers' administrative burden in 2020. You may refer to the detailed information on this slide, which can be also found from both tax and customs authorities' websites. And that's it for my presentation today. I wish you keep well and healthy throughout the COVID-19 situation and hope to see you in the next meeting soon. Thank you very much.
First of all, thanks to both Mr. Ted Kim and Tae-Gyung Kim for their excellent presentation. I hope it was interesting and useful for your practice and for your business. I know that we have a couple of questions that has been provided to us in advance. As I mentioned previously, to the extent that you have any questions that you would like to let us know, please use the Q&A button to send that to us. One of the questions that came up that I want to pose to, I will address that to Mr. Tae-Gyung Kim first, is in respect of COVID-19. There is a concern, I think, that past several years, at least for the past, 5 years, we all know that many of the special tax benefits that foreign companies received as part of their FDI investment have been eliminated, in part because of government decision, and in some part because of pressure that the Korea, as a member of OECD, received in respect of special taxing incentives and preferences that was considered harmful and anti-competitive. So what I wanted to ask Mr. Tae-Gyung Kim is, in light of what's going on, especially, of course, we're talking about COVID-19, that has had such a major impact on Korean economy, whether there is any consideration or possibility that in the upcoming tax law amendments and revisions and tax law introductions, whether there would be an opportunity for the government to introduce new tax rules that would be viewed as potentially incentives or other measures designed to provide foreign companies a additional reason, other than Korea being a good place to do business, additional tax incentive for investing in Korea. Mr. Kim?
So I mentioned 2020 special tax law reform regarding the Korean government's new policies to cope with COVID-19. However, it seems that the Korean government's legislation rather focuses on assisting domestic or national, I would say, corporations or individuals to boost the economy. As Mr. Shim just explained, I remember the Korean government deleted the tax incentives, such as corporate tax reduction on foreign investing companies in response to the European Union's challenge last year. Therefore, I personally believe that from a short-term perspective, the Korean government would not enact new tax incentives only to provide to foreign invested companies or for foreign direct investment in Korea.
Great, thank you very much. So I guess one way to try to find solution in this regard is to have a design rules or introduce rules that would potentially cover all type of companies, including foreign invested companies and foreign companies. The next question that I want to share with you and address to Mr. Tae-Gyung Kim is in connection with the OECD. As you know, OECD's massive effort of the past several years relating to the so-called BEPS action plan project, which many of you know has had significant impact in how taxpayers and tax advisors and companies do business, how they comply with the rules, and how they plan and undertake their transaction. One question that many of our clients have raised recently is we've seen a lot of these measures in Korea, which it appears to be consistent with the OECD BEPS action plan, but just to have a little bit more detail on whether currently Korea has largely finished adopting the BEPS action project, or there's some outstanding elements left. And I'd like to turn to Mr. Tae-Gyung Kim to address that point. Mr. Kim?
Korean tax authorities have implemented the anti-avoidance rule very strongly, and those anti-avoidance cases have been controversial. Korean tax law has adopted most of the measures recommended by the OECD Action Plan relating to tax avoidance, including artificial avoidance of permanent establishment, strengthened TP documentation, substance of a form rule of TP, and the principal proposed test included in the new OIB rule. As I discussed in my presentation, Korean tax law adopted a new OIB rule to make the anti-avoidance rule to be clear. Therefore, application of a tax treaty to the OIB would become more reasonable, but it is expected that Korean tax authorities would challenge the tax avoidance case more strongly based on the strength in the P rule and the transfer pricing, as well as shifting the burden of proof from the tax authorities to the taxpayer.
All right, it's 55 minutes past the hour, and AMCHAM has a very strict policy about keeping our presentation timely and within the allotted time frame. So I want to thank my colleagues, both Mr. Tae-Gyung Kim and Tae-Gyung Kim today for their excellent presentation. And we received some Q&A relating to submission or having access to the presentation materials. And AMCHAM has gracefully, kindly agreed to share the materials through the AMCHAM website. Again, thank you for joining us today, and we hope to provide another presentation in not too distant future. Thank you very much, and goodbye.